Hi, in this video we're going to look at investing in the retail sector. And this is the second video in our series of looking at investing in different stock market sectors. In the first video we looked at pharmaceuticals, now we're moving on to retailers. I think the first thing I'd say about retail is in many ways it's a relatively easy sector for private investors to follow. You know, we all go shopping, we all visit different stores, we have opinions on Marks and Spencer's, Sainsbury's and all the rest of it. And that's great. Visiting stores is great. It's a great foundation for your analysis. But I would really flag up that it's not enough. It's a start, but you need to do more work on top of the store visits to really become a great investor in retail stocks. So let's crack on and look at some of the other things you need to do apart from store visits. I think the first thing I'd say is actually just to flag up a sort of crucial difference, really, a crucial split in the retail sector between food retailers and non-food retailers. So, sounds fairly obvious, I know, but there is a crucial point here. Food retailers, the supermarkets, are normally good defensive stocks. So if we're in a recession, we all need to eat, and so supermarkets will probably carry on doing fine. The non-food stores, you know, the ones who sell carpets and clothes and all the rest of it, they're more cyclical. What I mean by that is, you know, if you're in the early stages of an economic recovery, as we are now, you'd expect more people to be moving house soon and buying carpets, buying new kitchens, and people will have more money to spend on clothes. So non-food retailers are more likely to do well in the good times. Of course, you do also get some retail stocks that straddle both sides. So, I mean, obvious examples are Tesco and good old Marks and Spencer's, who have both, so they've got both food and non-retail offers, non-food retail offers, and that's great. It should mean that actually they'll do well wherever we are in the economic cycle because they've got operations on both sides. Having said that, I'm actually not that keen on either company, so don't run out and buy shares in either one for now. So let's look at some of the other things now you need to look at. So we said already, store visits are really important. So when you make those store visits, look and see how crowded is the shop. And you try and make visits over a period of time. You know, does it remain crowded every time? Have they got the right goods in the shelves? Are the shelves fully stocked? Are they increasing the number of discounts on offer? I mean, discounts are fine, especially retailers like Primark, which are all about discounts. But if you went into a luxury retailer like Burberry and suddenly noticed the number of discounts was rising, that would be a warning sign that something might be wrong. So you really need to keep your eyes and ears open on store visits and actually do them repeatedly over a period of time, and also go to different shops in that retailer's chain. Then the second thing we need to look at is sales. And we need to look at total sales for the whole chain, and also something called like-for-like sales. You may have heard that jargon. So let's imagine a retailer, they've pushed up total sales by 10%. That sounds great at first glance, but they've done that because they've opened lots of new stores. And if you just looked at the stores in the chain that have been open for a year, the like-for-like sales, if they're down 5%, suddenly this retailer doesn't look so attractive. Fine, there's nothing wrong with growing sales by opening new stores, but at the same time, you don't want to see falling sales in your existing store estate. So if we saw figures like this, say, a 15% rise of total sales, and still at a 3% rise in like-for-like sales, that would be great. The chain is growing sales through new store openings, but sales are also still rising gently in the existing store estate. That's great. If you had those kind of sale numbers, the next thing to think about are returns on capital. We've looked at return on capital employed before, but we want to make sure that the chain is getting a good return that it makes on investments in new stores. If the chain is investing £1 million in a new store, but only making 20 grand profit from that store, that's a bad investment. It makes no sense. So a chain, if it's growing its store estate, it needs to carry on generating good returns on those investments, and it needs to carry on achieving good margins, especially gross margins. And if you see gross margins are falling in a retail chain, that's a big warning sign that something is wrong. It suggests to me that competition may be increasing, or the retailer is just getting something wrong about its offer. Another thing to watch out for is inventories. If inventories are rising, that again is a sign of trouble. The retailer is not being able to sell its goods as quickly as it once did. And then there's online competition. We all know how Amazon has inflicted huge damage on high street book retailers. And I think we're going to see more of that. I think one area that's particularly vulnerable are the high street electrical retailers. I'd be very wary of investing in Home Retail Group at the moment. This company owns Argos. Argos is a big part of home retail. And I think it's very vulnerable to Amazon, which is really good at really competing aggressively on price and getting all the advantages it can out of the online model. Having said that, offline competition is also important. You know, Primark doesn't have any online retail offer, but it's grown massively over the last 10 years, inflicted huge damage on M&S. And that's a big trend of the discount retailers coming in, offering really low prices and hitting the sort of more traditional middle market players. We're seeing that also happening in food with the likes of Lidl and Aldi that are now hitting the likes of Tesco's and Morrison's, again by offering really competitive prices. Last thing to look out for is overseas expansion. There's a long history of UK retailers expanding abroad and making a complete mess of it. Most recent example is Tesco's with its Fresh and Easy operation in the US. That's now been sold. Tesco have effectively put £2 billion down the drain, complete waste of money. More often than not, if a UK retailer is expanding overseas, I'd say that's a big warning signal. Don't invest. Final quick point. When you look at retail stocks, you can actually forgive them getting things wrong for 3 or 6 months. All retail stocks get it wrong sometimes. They buy the wrong clothes, the wrong fashions, just for a particular season. And they can turn it round and be back on top form 3 or 6 months later. But if you see poor performance for a year or longer, then that's more serious. But if things go wrong just for 3 or 6 months, don't panic, forgive them, things may be all right. So that's a quick overview of what to look for in the retail sector. Hope you found it useful. And until my next video, good luck with your investing.